From the 6th of April 2027, the amount you can put into a cash ISA each year is being cut from £20,000 down to just £12,000. That's £8,000 of tax-free savings capacity gone in a single budget decision. At the same time, the tax rate on your savings interest is going up. If you earn money from a rental property, that's going up too. 3 changes, all landing at once, and all pointed in the same direction. Now, if you're someone who keeps their savings in cash, which most people near retirement do, this feels like a direct hit. And honestly, it is. But there's a piece of the maths that most coverage of this story has completely missed. If you're a retiree or near retiree with savings or a rental property, subscribe now so you don't miss the workarounds we cover on this channel. The £12,000 limit only applies to cash ISAs. Your overall ISA allowance, the full £20,000, stays exactly the same. So the question isn't whether you lose tax-free space. The question is whether you know how to use the space that's still available. Gilts, UK government bonds, currently yield around 4.5% for short-dated ones. Money market funds sit at a similar level. Both can be held inside a stocks and shares ISA. Both carry very low risk. Neither counts as a cash ISA. So the £8,000 you can no longer put into cash. You can still shelter it from tax, just in a different wrapper. And in many cases, you'll actually earn more on it. Most retirees assume they have to accept lower tax-free savings or take on stock market risk. But the numbers tell a different story, and I'll show you exactly how it works in a moment. First, let's look at the 3 biggest 2027 changes that hit your pocket directly. Let's go through the 3 changes properly, because the detail matters more than the headlines. First, property income tax. From the 6th of April 2027, rental profits are taxed at a separate set of rates. Basic rate goes from 20% to 22%. Higher rate goes from 40% to 42%. Additional rate goes from 45% to 47%. That's a 2 percentage point increase across the board, confirmed by gov.uk. In cash terms, if you have £30,000 of rental profit and you're a basic rate taxpayer, that's an extra £600 in tax every year. Not a disaster on its own, but it's not nothing either, especially if your margins are already tight because of higher mortgage rates. And here's the part that catches landlords off guard. The relief you get on your mortgage interest costs, finance cost relief, is calculated at the property basic rate. So from April 2027, that relief is given at 22% instead of 20%. That part actually works slightly in your favour, but the net effect is still an increase for most landlords. Second, savings interest. The same 2-point rise applies. Basic rate goes to 22%, higher rate to 42%. Your personal savings allowance doesn't change. It's still £1,000 if you're a basic rate taxpayer, £500 if you're higher rate. But the tax you pay on everything above that allowance goes up. To put a number on it, if you have £50,000 in a savings account earning 5%, that's £2,500 in interest. If you're a higher rate taxpayer, your tax bill on the amount above your allowance increases by 2 percentage points, so you're paying roughly £40 to £50 more per year on that pot alone. It doesn't sound enormous. But across a larger portfolio, or combined with the property change, it adds up. Third, and this is the one that's generated the most confusion, the cash ISA limit. From April 2027, if you're under 65, you can only put £12,000 into a cash ISA each year. The overall ISA allowance, the £20,000 total, stays the same. But the portion you can hold in cash is being cut. This is the last tax year where you can put the full £20,000 into cash. After April 2027, that option closes for under 65s. Now, if you're a retiree who relies on cash savings for stability, this feels like the government is pushing you toward the stock market. I understand that instinct completely. But here's where the thinking tends to go wrong. Most people hear stocks and shares ISA and immediately picture volatile investments, shares in companies, funds that could drop 30% in a downturn. That's one version of a stocks and shares ISA. It's not the only version. The trap is assuming that your only two options are a cash ISA or stock market risk. That's not accurate, and the next section is going to show you why. So those are the three headline changes. But here's where it gets interesting. The cash ISA limit cut doesn't have to reduce your tax-free savings at all. There's a workaround that's been hiding in plain sight, and it involves some of the safest investments available. Let me walk you through the mechanics properly, because once you see how this works, it changes the picture entirely. The £12,000 limit only applies to one specific type of ISA, the cash ISA. Your total ISA allowance remains £20,000. That means the remaining £8,000 can go into a different type of ISA, including a stocks and shares ISA. And here's the key point. A stocks and shares ISA doesn't have to hold shares. Short-dated gilts, UK government bonds with a maturity of around 1 year, are currently yielding around 4.5%. They're backed by the UK government. They're about as safe as a savings account at a high street bank, and in some ways more so. You can hold them inside a stocks and shares ISA through a gilt fund, and the income is tax-free. Money market funds work on a similar principle. They invest in short-term government debt and similar instruments. The yield is around the same level, roughly 4.5% at the moment. Very low volatility, very low risk. And again, they can sit inside a stocks and shares ISA. I used to think cash ISAs were the only sensible option for retirees who wanted to keep things safe. After running the numbers on gilts and money market funds, I realized I was leaving hundreds of pounds on the table every year. It's not about taking risk, it's about knowing how to use the rules that already exist. Now let's look at what the numbers actually show. Option A. You put the full £12,000 into a cash ISA at 3.5%. Tax-free income, £420 per year. That's the limit. You've used your new cash ISA allowance, and the remaining £8,000 sits in a regular savings account, where the interest is taxed. Option B. You put £12,000 into a cash ISA at 3.5%, and £8,000 into a short-dated gilt fund inside a stocks and shares ISA at 4.5%. Tax-free income, £420 from the cash ISA plus £360 from the gilt fund. Total £780 per year, completely tax-free. That's an extra £360 compared to option A, for the same level of safety. The £8,000 that the government has removed from the cash ISA. It hasn't been removed from your tax-free allowance. It's just been moved to a different shelf. If you're 62 and planning to retire next year, a practical split might look like this. You put £12,000 into a cash ISA, easy access, for your emergency fund and short-term spending, and £8,000 into a short-dated gilt fund inside a stocks and shares ISA, for your medium-term savings, earning slightly more, still completely tax-free. Premium bonds are worth mentioning here too. They're already tax-free and sit outside your ISA entirely. They don't eat into your allowance at all. If you hold premium bonds, they don't need to be part of this calculation. But what about the property tax changes? If you're a landlord, the decision is more layered, and the wrong move could be a costly one. There are 3 things worth doing as a result of these changes, and the first one has a hard deadline. Step 1. Maximize your 2026-27 cash ISA while you still can. The full £20,000 cash ISA allowance is available until the 5th of April 2027. After that, the limit drops to £12,000 for under 65s, and it doesn't come back. If you have the cash sitting in a taxable savings account right now, moving it into a cash ISA before April 2027 is one of the clearest actions available to you. Once that window closes, you can't go back and fill the gap. This doesn't mean you need to rush into anything, but if you've been sitting on savings you haven't sheltered yet, this tax year is the last chance to shelter the full amount in cash. Step 2. From April 2027, plan a split. Put £12,000 into a cash ISA, easy access or a fixed rate account, depending on your needs. Put the remaining £8,000 into a stocks and shares ISA invested in a short-dated gilt fund or a money market fund. Both are low risk, both are tax-free. You keep the full £20,000 allowance working for you, and the gilt or money market portion will likely earn slightly more than a standard cash account. This doesn't require ongoing management. It's a one-decision structure. Step 3 applies specifically to landlords. If you're 55 or older and you've been thinking about selling a rental property, the 2027 tax changes add one more variable to the calculation, but they don't automatically make selling the right call. Here's the maths to run. If you have £30,000 of rental profit as a higher rate taxpayer, your tax bill goes from £12,000 to £12,600 from April 2027. An extra £600 per year. That's meaningful, but it's not necessarily a reason to sell. Now compare that to selling. If you sell and release £200,000 and you invest that in ISAs earning 4%, you'd generate £8,000 of tax-free income per year. That could well exceed your net rental income after tax. But you also need to factor in capital gains tax, currently 18% for basic rate taxpayers and 24% for higher rate taxpayers on property gains, plus the loss of any future capital appreciation on the property itself. Most landlords assume selling is the obvious answer when costs rise. But if you have a low mortgage balance and a reliable tenant, holding on might still produce more income over the medium term. The point isn't to pick a side, it's to run the actual numbers for your specific situation before deciding. And that's the underlying message across all 3 steps. The 2027 changes aren't a catastrophe. They're a shift in the rules that rewards people who adjust and costs money for those who don't. But here's the psychological barrier that stops most people from acting. And it's not about the numbers. There's a pattern I've noticed when people hear about tax changes like these. The first reaction isn't confusion, it's a kind of flat resignation. What's the point? They keep moving the goalposts. I get it. You've saved responsibly, contributed consistently, played by the rules, and every couple of years something shifts and it feels like you're being penalized for it. That frustration is completely understandable. You're not being lazy, you're being human. Psychologists call it learned helplessness, the tendency to stop trying when you've been hit enough times that effort starts to feel pointless. It shows up in retirement planning more than people realize. Someone who started late and keeps getting told the rules changed tends to disengage, even when there are still good moves available. I've been there too. A few years ago there was a change that affected my own planning, and my honest first reaction was to think about doing nothing. Just leave it. But when I actually sat down and ran the numbers, the cost of doing nothing was far higher than the cost of adjusting. The frustration was real, the excuse to stop wasn't. The reframe that tends to help is this. Instead of thinking the system is working against you, think about the parts of the system you can still work with. The ISA workaround I showed you is one example. Using your spouse's ISA allowance on top of your own is another. Timing pension withdrawals to stay within a lower tax band is a third. These aren't loopholes in a negative sense. They're the rules as written, used as intended. You don't need to do everything at once. You just need to stay engaged enough to take the next useful step. So the real question isn't, why bother? It's, what can I still control? And the answer, even after these changes, is quite a lot. Let's bring it together. From the 6th of April, 2027, 3 changes land at once. Property income tax goes up by 2 percentage points across all rates. Savings interest tax goes up by the same amount. And the cash ISA limit for under 65s drops from £20,000 to £12,000. None of these are minor, but none of them are as damaging as the headlines suggest. If you understand what's actually available. The cash ISA limit cut doesn't reduce your overall ISA allowance. The full £20,000 is still there. The £8,000 that can no longer go into cash can go into a stocks and shares ISA holding gilts or a money market fund. Low risk, tax-free income, often at a better rate than a standard cash account. The loss is smaller than it looks, and for some people it's not a loss at all. For landlords, the 2% rate increase changes the maths on whether to hold or sell, but it doesn't automatically answer the question. That decision depends on your mortgage, your tenant situation, your capital gains position, and what you'd do with the proceeds. Run the numbers before you decide. And if you felt that tired, flat, what's the point feeling when another tax change comes through? That's normal. But the cost of disengaging is real. The small adjustments are worth making. If you're a retiree or near retiree who wants to protect your savings from these changes, hit subscribe. I'll show you how to navigate each one with practical numbers-based strategies. The rules are changing, but your ability to adapt is what actually determines your retirement security. Thanks for watching. I'll see you in the next video.